Will rising energy prices crash housing market? What does historical data from the U.S. Federal Reserve show? Will rising energy prices crash home values in the United States? The United States Federal Reserve has economic data on the price of gasoline and other energy from the 1970s to the present. It also has house price indices, both nationwide, shown here, and in various areas from the 1970s to the present. This plot shows the relationship between gasoline price, something you see at the pump, not spot oil price or other prices that may be influenced by speculators or other phenomenon. It shows the gas price, which is shown in the cyan, the light blue diamonds. It shows the home price or the house price index from the Federal Reserve scaled to fit on the same plot. So the house price index is typically in units of 100. It's scaled down to the same units as the gas price of dollars per gallon, and here the index is represented as 4 or something like that instead of 400 and something. As you can see, there's a lot of variation. Did rising energy prices crash home values in the United States in the 2000s? The straightforward answer is no. You can see the prices rising between about 2002 and 2007 at the same time that gasoline prices and other energy prices were soaring. Home prices soared as energy prices soared from 2002 to 2007. Here we zoom in on that period. Again, you can see in the green the house price index going up and up until the housing bubble crashed. You can also see this was happening as the gasoline price and energy prices soared after the U.S. invasion of Iraq. Going back to the energy crisis of the 1970s, home prices dropped as energy prices soared from 1979 to 1982, the reverse relationship. You can see here again the house price index going up to about 1979 and then dropping as gasoline prices soared following the Iranian Revolution. Energy prices historically have little or no relation to home values in the United States. Any effect on commuting costs is quite small, apparently, compared to other factors. What about new technologies like AI and Zoom? These technologies have the potential to significantly affect regional housing markets, especially expensive housing markets, in much the same way that the gross decline in manufacturing in the United States heavily depressed housing markets in Flint, Michigan, Detroit, and many other industrial centers, a problem that continues for some communities to this day. AI seems likely, if it achieves its goals, to eliminate the high-paid jobs of many people who buy homes in expensive areas, including software engineers, including managers, including marketing professionals, and many others. AI is a new technology. It's not really a proven technology, although it's getting better. Zoom and other video conferencing tools and remote collaboration tools are battle tested during the lockdowns and are being used already widely by people who are able to relocate to less expensive areas and work remotely. This seems likely to depress and adversely affect expensive areas where people may have a lot of their wealth tied up in a home. Give the trial version of Home App, the Home Purchase Risk Estimator, a try. This is an early beta version of the software which is designed to evaluate these long-term structural risks and other risks using data from the U.S. Federal Reserve and other sources. Give it a try.